Alright, this is the second part in long-term liabilities lecture, and here we're going to talk about discount loans. And the reason we're going to talk about discount loans, it's an easy way for us to see what do we do when there's not a payment of interest, but there is interest expense. So this is an extreme case, and these do exist in the actual world. There are zero interest-bearing loans, or also zero interest-bearing bonds. Sometimes they're just referred to as zeros, or zero coupon bonds. So this type of instrument just has a lump sum payment at maturity. There is absolutely no intervening interest. There are no intervening interest payments. Okay. So the amount payable will go into notes payable. So the principal, I should say, to be clear, goes into payable. So to value the difference between the face value of the item and today's book value of the item, we're going to use this account called a discount account. So this discount account, because it has a normal debit balance, it is a liability. This one in particular could be referred to as a contra account. But more generally, it's a valuation allowance. As we're going to see, we're going to have premiums which have credits to adjust the values up from their face value. So this is the general term is a valuation allowance. And this is contra because it's a liability with a debit balance. All right. So in this example, Sophia Software is going to get that $240,000 loan for 3 years at 10%. So the loan requires that they only pay the principal amount in full at maturity. So the first thing you do is you calculate the cash proceeds, and the cash proceeds are going to be the present value of, at 10%, 3 periods, $240,000. So you discount that lump sum 3 periods. So if we're using, let's see, the table, the factor 1 period, 3 periods, 10%, 0.7513 times 240,000 equals 240,000 times. So I get, with the factor, I get 180,316. So I'm going to do this again with just math. Divided by 1.13 times will get me there. And I also get 183.16. That's a little surprising, but okay. Why is it surprising? Because we have 4 significant digits here and 6 here. Okay, well, that worked out. And let's see. Okay, so the table's working out here. And it says to fill in this repayment and interest schedule. So this one is this schedule is a little bit different than most because just to try to be more clear, it has the carrying value at the beginning and the carrying value at the end in one row. So typically a 1231 journal entry will only have the ending value, or schedule, excuse me. But just so we can get see where we're going. Now, this is the effective interest method. You take the beginning of period carrying value, multiply it times 10%. That's the interest expense. If there were a payment, the amount of the difference between the payment and interest expense would change the carrying value. Since we don't have any payment here, this is dollar for dollar reducing the carrying value. So 198,348 is just 180,316 minus 18032 equals 198,348. Then you take it by 10% again, and you get 19,835. And we do the same thing, update the carrying value. So the effective interest method is carrying value at the beginning times the effective interest rate equals interest expense. Okay. Now, in the last year, I just want to point out it gets a little bit weird. This is, if you times this by 10%, it's 21,818, but there's a dollar of rounding. So the thing to do here is to just take this 218,183 and take the difference between these two. Alright, that way you plug the last year, and this ends up being 0, and your total carrying value ends up being $240,000, which matters because you're going to make a $240,000 payment. Now, let's go look at the journal entry, see how we deal with this. Well, here's the issuance. The note payable or bond payable account always holds that principal value, always, always, always. So we didn't put 183.16 credit. What we did was the book value is across two accounts. Here's the book value of the note. So it's the note payable less discounts or plus premiums. And here's the cash proceeds, 183.16. Interest expense, but we don't have any cash, so what are we doing? We're crediting the discount account, which will have the effect of raising the carrying value or the book value every period. Carrying value and book value can be used interchangeably. Interest expense discount, and then the payoff on the last day. So if we think about what's going on here, I mean, I don't have a lot of room to work, but let me put a T account right here. We started with a discount of $59,684, and we ended with a discount of 0. And along the way, we credited 18032, 19835, and 21,817. So you add those all together, those are going to equal 59,684. So the other thing, so you know what your total interest expense is going to be. The amount you received was 183.16. The amount you pay is 240. The difference between those two is 59,684. So in this case, that was the interest expense. If no one had told you about this effective interest method, and you knew you were going to have 59,684, this is total interest expense for 3 years. 3 years. You could have just split it up, and 19,895, 19,895. Let's say 39. So if you take 19,895 twice, it's 39,790. Subtract 59,684. Okay, so what is this plug number right here? There's a little bit of rounding error, so the whole idea is to go to 0, so you want to go to 0. So you got to plug the 19,894. So this is straight line. All right, straight line. It's GAAP, but not preferred. So straight line. And in general, what does that mean if something's permitted but not preferred? What that means is if the difference between the permitted and preferred methods aren't material, then it's not an issue. You can use the other method. These come into play when if you have a bond, but it's a really small part of your capital structure. There might be places where you don't have a lot of something that the interest method, effective interest method, is preferred. You don't want to go through the hassle of calculating it. Generally, any firm that uses effective interest method or has instruments that it applies to, they're going to use the preferred method. So even the smallest bank, because virtually all of their balance sheet is debt instruments, they're going to use the preferred method. Okay, but we will see a little bit of straight line, usually to make problems easier where we're focusing on something other than the effective interest method. But the whole point, the bottom line here is the effective interest method is just a way to take this 59,684 and spread the interest expense, across 3 periods. It's just a rule for doing that. All right, so now we're going to talk a little bit about bond market and structure, a little bit about that, and then we'll actually get into the accounting after that discussion.